Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video we are looking at 5 different companies that that are undervalued at the moment that you could potentially look into for the month of December. We do this every single month. We're looking ahead to the following month or the month that we've just started, which is December, and we look at some companies that you could potentially do a bit more research on, and that's exactly what we're going to do in today's video. So 5 companies that are undervalued at the moment, discounted based on the valuations from Morningstar and other companies as well. So before we do that, as usual, give the videos a like because it makes a huge difference. Of course, 50% of you guys that have that watch the videos regularly are not subscribed to the channel, so I would really appreciate if you can subscribe to the channel. Let me know if you have any questions and so on, and it takes a lot of time to put these videos together, so I would really appreciate if you can just like the videos. As well as that, you can join us in the Patreon account. You can support the channel by doing any of these things. You can either join the £2 or £4.50, where you get access to a lot of things like the dividend trackers, the ETF trackers, the watch list, the daily watch list, the private Discord and so on. So inshallah, if you can, that will be really helpful. Let's now start the video. I want to make this video as short as I possibly can. So like I've always said to you, do your due diligence before you invest in any of these companies. Again, this is just for entertainment, to show you some of the companies that are undervalued, share with you guys some of the research, and then of course you're going to have to do your own research. Okay, right, so what we're looking for is the company, the market cap, the moat. The moat kind of helps us understand how basically competitive these companies are, and if they have a competitive advantage over their competitors. Okay, so moat around a company, that means basically the company has they can protect their market shares, basically the current price of the stock, the dividend yield, the payout ratio, the latest increase in terms of dividend, the 5-year growth rate in terms of dividends streak, so how long they've been increasing that dividend, annual payout. This is important to me because that shows me if the company is a dividend growth or so on. We were looking for the annual payout, which means basically how much money wise they will give us in every single month. The safety coming from dividend safety website, which is this website here. Okay, so some companies, for example, will have 98, some have 50% and so on, so we need to know that. The profit margin, return on equity, free cash flow, total return in the last 10 years. We're also looking for the growth estimate for the next year, in case of 2024, and the growth estimates for the next 5 years, every single year for the following 5 years. Again, this is just estimation. It comes from Yahoo Finance analyst, and Yahoo Finance uses analysts from all sorts of banks and so on, investment firms and so on. We're looking for the valuations from Morningstar. I trust Morningstar more than any other company out there. The reason is because they use the intrinsic value, and it's quite it gives you kind of bit of a margin of safety. And again, even though it says 20% discounted, I still put it onto my watch list, and again I basically give myself margin of safety, maybe 5%, 10%, 15%, depending on that. So I do think they are quite realistic in comparison to other websites that I've seen. And then the fair value price, the price where they think the stock should be trading at right now. Okay, right, so the first company that we're looking at today is Cummins. Cummins is one of the companies that I own in my portfolio. The company designs, manufactures and distributes and serves diesel and natural gas engines, electric and hybrid powertrains, and related components worldwide. It operates through 5 different segments. So first one is engine, distribution, components, power systems, and new power. The company offers diesel and natural gas powered engines under the Cummins name, as well as they create other basically engines for other companies. So they have brand name ones that they are their names on the engine, and sometimes the other companies come to them and they create the engines for these companies and put their logo and all of that stuff. Okay, right, it has a market cap of $32 billion. It has a narrow economic price right now is $233 per share. It has a dividend yield of 2.8% right now. Payout ratio is only 32%, and latest increase was 7%, and the 5-year growth rate of 7%. To me, this is really important. Dividend streak of 17 years, so they have been increasing that dividend for 17 years. Annual payout is $6.72, and safety is 98%. The highest any company can get is 99%. Profit margin right now is 8.4%. Return on equity almost 30%, and free cash flow right now just above $1 billion. Total return in the last 10 years, we're looking about 8%. They're expecting the earnings to decline about just 2% next year, and then after that, every single year the following 5 years, they're expecting the earnings to grow about 11%. It's 10% discounted right now according to Morningstar. $255 per share is where they think the price should be. The next company we're looking at today is Teradyne. This company designs, develops, manufactures, sells, and supports automatic test equipment worldwide. The company operates through basically through semiconductor test, system test, industrial automation, as well as wireless test segments. So they are in that sort of a semiconductor testing side of things. $14 billion market cap. It has wide economic moat. Right now it's trading $93 per share. Dividend yield is just below 0.5%. Payout ratio 14%. Latest increase was 0, so they have not increased this dividend. The 5-year growth rate is 9%, and the dividend streak, basically they have just increased it once, I think, in the last few years. Annual payout, so it's one of those companies, they don't really put a lot of emphasis maybe in the dividend side of things, but the annual payout is only 44 cents. Safety is 74%, profit margin of 18%, return on equity of 21%, free cash flow of $369 million. Total return in the last 10 years, we're looking at about 19%. So you can see that's probably more of a growth company if you think about it than actually dividend paying company. Growth estimate for next year is 29%, and after that 11% every single year. 37% discounted. $147 per share is where they think the price should be right now. The next company does not need any introduction. This is a Mastercard. You just have to look on your wallet. You probably will find a card that this company owns. As always, I keep saying this company does not deal, it's a Sharia compliant, does not deal with anything that's haram, and especially with the technology behind the cards. What these cards, what the companies, so for example Barclays or whatever, do with the cards, it's nothing to do with the company. They facilitate for the transactions, making sure it goes from A to B, they get their cut. Okay, $387 billion, wide economic moat, $411 per share right now. I used to own this company, and I think I sold it in 370s. So it has gone up since that time. Dividend yield just above 0.5%. Payout ratio 19%. Latest increase in terms of dividend was 16%, and the 5-year growth rate in terms of dividends is 18%, which is absolutely huge. I love the double digits here. The dividend streak is 11 years. And annual payout, so they have increased it for 11 years in a row. The annual payout is $2.64. Safety 99%, profit margin of 44%, return on equity of 172%. Free cash flow right now almost $10 billion. Total return in the last 10 years about 19%. Growth estimate for next year is about 17%, and then 20%, almost 21% every single year for the following 5 years. That's absolutely huge. Again, it's an estimation, of course. It can happen, it might not happen, but that's absolutely huge. Fairly valued according to Morningstar right now, $406 per share is where they think the price should be. Right now it's just above that, $411 per share. The next company is another company that does not need any introduction. This is Exxon. It's an oil company, oil giant. This and Chevron are the two biggest companies in the United States when it comes to oil, and it's going to get bigger. I think they're acquiring one of the companies out there called Pioneer. So I think they're acquiring that, so it's going to get even bigger. $393 billion market cap right now. It has a narrow economic moat. Price right now is just below $100 per share. Dividend is $3.73% dividend yield. Payout ratio 35%. Latest increase about 4.4%, and the 5-year growth rate of 3%. They've increased this dividend for 40 years, which means 25 or more is a dividend aristocrat. So the company is a dividend aristocrat. Next 10 years, they will become dividend king if they continue increasing that dividend every single year. The annual payout right now is what you will get is $3.80. Safety is 80%, and profit margin of almost 12%, 21% in terms of return on equity. Free cash flow right now $37 billion. I need to look into this company. I'm really interested. I don't have any oil companies in my portfolio, and I think one of the subscribers asked me recently. The thing is, I don't really understand the oil side of things, and it depends. Again, it's similar to basically iron ore, Rio Tintos and whatever. When the price of the WTI goes down, everything else goes down with it. So I've always just stayed away from it, and especially in 2022, I think it went up so much, and then 2023 is, I think a lot of these companies are flat right now. So I don't know if I should. So I'm gonna do a little bit more research on this company and find out what's happening, and find out whether they acquiring Pioneer. So I want to find out whether that's cash, whether that's a stock, whether basically they actually getting debt and getting more debt and so on. So I need to find out a bit more information. But I am interested. The fact that it's actually below 100 right now is interesting. Can you believe, actually, I used to own this when the price was $40, I think, or 30 something, or $40. Back in the days, that was in early 2020, when the price of oil was literally zero. People literally, it was zero, genuinely, like it got to that point, and these companies tanked so much. I wish I knew a lot more about oil companies at that point, because I would have bought more. Anyway, carrying on with the video. Total return in the last 10 years, we've got about 3.2%. Again, that kind of puts, even including dividends, only 3.2. So I'm like, okay, is that really a good investment? So that's one of the reasons why I haven't looked more into oil companies. There are some companies that have a lower total return in the last 10 years, but oil, I think, probably has the lowest out of all of them. So growth estimate for the next 5 years, next year, sorry, is 3%. And then growth estimate for the next 5 years, about 45%. Now, this includes, I think, is the fact that they're acquiring that business. So it's not just organic growth. I think it's more to do with the fact that they're acquiring another business. And of course, for that reason, their earnings per share and so on, everything will just kind of go up. So 20% discounted right now, $123 per share is where Morningstar think it should be. Just for that reason, actually, I might just look into it and start nibbling, add bit more, get that dividend, and then hopefully that when it bounces back that 20%, actually, of course, it will be a good investment, right, going forward. But again, I just need to learn a bit more and find out how they're paying for that company, right? The final company is Medtronic. Again, another company that I've actually owned in my portfolio. This company is in the healthcare. They have all the devices that are used in hospitals, including diabetes and so on. Right now, they have a 106 billion market cap. It has a wide economic price right now, just below $80 per share. Dividend yield right now is 3.3% right now, which is absolutely amazing. And payout ratio is 52%. Latest increase was 2%. I think this was just to keep us happy. I think it was like, I think I've rounded it out, but it was like 1.5 or something like that. But yeah, to keep us going, and for the fact that they didn't want to lose their dividend aristocrat status. But 5-year growth rate of 8%, and the 45 years of increasing that. So I'm glad they did that. So they can now, once the company bounces back and the revenue starts going up, hopefully they can give us a bit more in terms of dividend increases. The annual payout right now, we're looking at $2.76. And the 5-year, the profit margin, safety 99%, profit margin of 13%, return on equity about 8%, free cash flow right now $4 billion, total return in the last 10 years about 6%, estimation for next year is 5%, then 3% after that, 29% discount right now, $112 per share is where they think the price should be. Finally, from Sharia compliance side of things, you can see all the companies, absolutely no issues whatsoever. Of course, Medtronic is slightly higher in terms of interest-bearing debt, as well as Cummins, but I've nothing to worry about when it comes to that. Right, so there you have it. That's the 5 companies that I wanted to talk about. Like I said, I own Cummins, I don't, and I own Medtronics. So I'm going to quickly show you, just to be transparent. Cummins, I have 17 shares right now, over £3,000. I'm up about £300 right now. And Medtronic, as you can see here, just over £3,400 and 54 shares owned. And right now I'm down about £430 or 11%. There you have it. That is my take on these companies. Again, all of them seem basically cheap right now. But again, if you're interested, please do your own research. Find out a bit more information about the companies before you start investing. Have a wonderful, wonderful day. Assalamu Alaikum.